Welcome to RagingFX's Forex Trading Course, week number 5. If you'd like more information about this course, please visit us at RagingFX.com. Today we'll be covering part 2 of our Forex Risk Management segment. But first, let's look at a quick review from part 1. In part 1, we covered 3 key concepts. First, we showed you how to calculate your personal risk profile number. That number represents the most you would be comfortable losing in one day. So for example, for a $10,000 account, a 3% risk profile number would indicate that the most you would be willing to lose in one day of trading would be 3% of the total, or $300. We then introduced the terminology of a pip. A pip, if you recall, is the minimum price movement used for any currency. And finally, we addressed trade size, where a one-lot trade is the generic trade size RagingFX uses for its calculations. Now, let's combine these 3 key concepts to see how they can be related. If we were to place an order to buy one lot trade of euro-dollar, that is, trading at $1.18 US, then sold it after 1 pip move, we would generate a profit of 10 US dollars. That's a fact. If we sold it after a 10 pip move, we would profit $100. And finally, if we sold it after a 30 pip move, we would profit 300 US. Incidentally, the 30 pip move is also equal to our earlier stated $300 maximum daily loss allowance, so keep that in mind. So, let's now pick up the discussion again with a few relevant questions. Question number 1. Does this 300 for 30 pip price move apply to all the currency pairs equally? The answer is no. It only applies to pairs that have the letters USD positioned second, for example, euro-dollar or sterling-dollar. Question number 2. How should one manage risk with the other pairs, where the letters USD are listed first, such as dollar CAD, dollar Swiss, etc., or not at all, for example, euro Swiss or euro sterling? To answer these questions, let's categorize the 12 major pairs that RagingFX currently monitors into 3 types. But first, here's a quick review of key terms used in the industry. For the euro-dollar pair that is trading around $1.18, the currency listed second is called the quoted currency, because the price movements on the charts are measured in US dollar terms. The currency listed first is referred to as the base currency. We'll use their respective positions to categorize them in 3 types. First, there's type number 1. Here's the US dollar is the quoted currency. This list includes the following pairs, and I'm going to state them in Forex jargon. They are Aussie dollar, Euro dollar, cable, and Kiwi dollar. The second type shows the US dollar as the base currency, while the third lists pairs that do not show the US dollar at all. So there you have it, all 12 major pairs categorized into 3 types. Now let's look at currency type number 1, where the US dollar is the quoted currency. As we saw earlier with the euro dollar, a 1 pip price movement up or down is equal to $10, and a 10 pip move is 100, etc. This table does apply to all 4 pairs listed on the left. From this slide, we introduce a golden rule, which means you should commit it to memory. Here goes. For a one lot trade, 1 pip is equal to 10 of the quoted currency. Hence, for all pairs where the US dollar is the quoted currency, a 1 pip move always equals a $10 gain or loss. Now let's see how we can apply this rule with currency type number 2, where the US dollar becomes the base currency. Here the quoted currency is different for every pair. So based on our golden rule number 1, a 1 pip move for the dollar CAD pair, for example, would look as follows. A 1 pip price move equals 10 Canadian dollars, because the Canadian dollar is the quoted currency. A similar table would apply to all 3 pairs listed. Notice how pips vary in value for each pair. For example, a 1 pip move with the euro dollar is worth more than a 1 pip move with the dollar CAD. Let's compare the different pips using a visual approach. First, we'll look at the euro dollar example from an earlier slide using a scaled line graph. On the top are the price quotes that we saw earlier from 1.18 to 1.1830. And below are the pip equivalents, 0 through 30, based on 1 pip equaling $10. So you can see the 10, the 100, the 200, and the 300. Now let's look at the same example using the dollar CAD pair, which has the Canadian dollar as the quoted currency. From a quick glance, you might be asking, why is the dollar CAD line shorter than the euro dollar line? Both are 30 pips long. The answer lies with the exchange rate. The Canadian dollars are valued at 78% of a US dollar, which is the same as saying that 1 US dollar is equal to 1.28 Canadian dollars. To properly compare both pip values, we scaled both line graphs accordingly. This comparison brings us to an interesting point. What if we drew a vertical line between both graphs like this? When we did, we can see that a 30 pip price movement in Canadian dollars is really equal to 23.4 of the US pip equivalent. That means that 30 Canadian dollar pips are essentially equivalent to 23.4 US dollar pips in today's exchange rates. By keeping the $300 US dollar maximum daily loss limit in mind, let's see how the pros apply some easy math to manage their daily risk pip count. When trading type number 2 currency pairs with the US dollar as the base currency, here's what the pros do. Step 1. They convert quoted currency pips into their equivalent US dollar pip value. Then they do step number 2. They calculate the equivalent US dollar pip value by, now here's the trick they use, divide 30 pips by the pair's exchange rate. Let's look at some examples by applying some easy math. If I were to take 30 pips, divide it by dollar CAD, which is the exchange rate is at 1.28, it would give me the pip US dollar equivalent, pip equivalent at 23.4. You can do the same with the dollar Swiss, simply 30 divided by the current exchange rate. And you can do the same with dollar yen. Now the only difference in yen, there is an exception, as there always is in every rule, that whenever yen is the quoted currency, meaning it's on the second position, divide the exchange rate by 100. It's the only way to make it work. I don't make these rules up, but that's how the yen works. In the next video, we'll cover type number 3, where the US dollar is not included in the pair. But for now, try to get an understanding and, most important, an appreciation for calculating the US dollar pip equivalent numbers. Thank you for your time. We hope this video clarified key distinctions for you. If you have any questions, please post them below or send us an email from our website, RagingFX.com. Thank you.